Picture the chaos of Wall Street in 1934. Markets reeling, confidence shattered, yet in this storm Benjamin Graham sits calmly at his desk, blueprinting a method to navigate the madness. What if the secret to long-term wealth isn't in chasing the hype, but in digging deep beneath the numbers? Graham's security analysis teases out a formula to find true value in a world that seems to reward speculation instead. Before tech booms and algorithmic trades, there was a different kind of investing, a patient, scientific approach. Graham and Dodd's framework flipped the script on how investors sift through a mountain of financial noise. Graham's famous case study on Northern Pipeline stock shows how he bought shares priced well below the company's tangible assets during the crash's panic. That margin gave him a safety net, like buying a house for 70% of its market value, and he lived to see it rebound with huge gains. Think of financial statements like an onion. Every layer has flaws and facts. Security analysis teaches you how to peel through the balance sheet, income statement, and footnotes, detecting what's real and what's creative accounting before you make a move. The real magic? Investors often flee markets when fear hits, creating bargains. Graham's strategy is to be the calm contrarian who swoops in just as others run out, turning what looks like rubble into treasure. Numbers alone aren't gold. Graham drills into how to read between the lines, exposing illusions that fool traders every day. Let's unpack how he turns raw data into investing wisdom. Graham points to the 1929 crash, where companies posted glowing earnings but hid massive debt and questionable asset values. One example involved a railroad company whose earnings looked solid but had piled on risky bonds, a bomb waiting to explode. Book value measures the true net worth of a firm's assets minus liabilities. Graham calls it the anchor to reality, a knife-edge test of whether stock prices have drifted into fantasy land or are grounded in something real. Debt is a double-edged sword. It can amplify profits or cut you deep. Graham compares it to a lever. If a company leans too hard on debt, one misstep can trigger collapse, but used smartly, it can fuel steady growth without tipping the balance. Decades later, Graham's lessons resonate louder than ever. In today's tech frenzy and gig economy, his principles act as a compass amid the noise and risk of speculation. The recent dot-com bubble and 2008 crisis proved Graham's margin of safety mantra. When stocks soar on hype, Graham's timeless guardrails remind you to step back and only buy when the price backs up the promise. Warren Buffett famously said he's read security analysis 4 times. Buffett's own career, turning Berkshire Hathaway from textiles to titans, is a testament to Graham's foundation, proving that discipline and research build empires. Value investing legends like Seth Klarman and Howard Marks keep Graham's torch burning. Their new commentaries in this edition show that no matter the decade, the formula of intrinsic value plus patience beats chasing trends and being a market jockey. Remember Graham at his desk, steady amidst the 1934 market chaos. That calm clarity cutting through noise with steady principles is your superpower now. Next time you scroll through stock tickers or financial headlines, try this. Hunt for companies selling for less than their true value and imagine buying a treasure trove, not a lottery ticket. Your portfolio will thank you for the patience. Subscribe for more book summaries like this one.